Well, I see a nice little group join here, so let's go ahead and get going so we can be respectful of everybody's time. So first off, just wanted to welcome everybody. Thank you for spending part of the evening with us and talking about physician tax planning for 2021 and beyond. My name is Cameron Helmuth. I'm one of the financial advisors here with Vestia Personal Wealth Advisors. For those of you who don't know us at Vestia, Vestia strives to be the first assist for all things financial when it comes to physicians in their lives. And these could include things like contract negotiation, retirement planning, asset protection planning, and innovative tax strategies. So before we get started, I'm going to start with just giving you a quick disclaimer in that I myself am not licensed as an attorney or an accountant. And although Abby is licensed as an accountant, what we're going to talk about tonight, it's just informational. It's not meant to be advice. It's very important that everybody talks to their own CPA or an attorney to talk about their individual situation before they implement any of the things that we're going to talk about this evening. So part of the reason we are here and we are partnering with Abby, though, is that we understand that to have a well-rounded financial plan for doctors, it has to incorporate tax planning and proactive tax planning, which is what we're going to talk about tonight. Just staying up to date with what these potential changes could be and how you could hedge against these changes actually coming to fruition. So that is something our team does every day, is coordinating with people like Abby or your team of professionals to make sure that you have a very well-rounded plan. So if you're interested in discussing your personal financial planning, feel free to reach out to us. You can visit us at vestiaadvisors.com and you can use the contact us form, or feel free to email us directly at myteam@vestia.com, and we would be really happy to talk with you about your own situation. So tonight we have our guest is Abby Cox. Abby is a 15-year veteran of the accounting industry. She's a senior manager for Somerset CPAs, and she focuses most of her time on healthcare and their businesses. So she works with doctors and self-employed physicians every single day. And I'm sure Abby will tell you a little more about her own background, but I'm very excited to have her here and to share some of her knowledge and talk about some of these potential changes. And what I do want to make sure is that this is supposed to be interactive. We want you guys to get the most out of your time because we know it's very valuable. So I do have a few questions I got through registration, but as we go along, please feel free to put any questions that come up from Abby's discussion. You can either message me directly, Cameron Helmuth, or feel free to put it in the group chat. I'll monitor along the way, and then I'll make sure that we get those questions answered from Abby as we go along. So with that being said, I will turn it over to Abby.
Good evening, everyone. Thanks for being with us. As Cameron said, I've been in the accounting business for about 15 years now. I have been in tax the entire time, and I've been focused on the healthcare industry for about the last 10 years of this. So I work primarily with physicians, physician practices, orthopedic groups, and doing their tax returns as well as income tax planning for the business and individual perspective. So if you guys have questions, obviously Cameron's going to handle those for us, but if you have questions after this and you need to speak with an accountant, I'll give you my information at the end, and you can always reach out to myself or someone at Somerset CPAs, and we'll be able to assist and guide you through this. Like Cameron said, there's a lot of potential changes with the new presidency. So we're going to go over those and kind of compare and show some scenarios so you can see what it would look like under the current tax laws, and then what things will look like as the proposal may come to fruition. Biden has his proposals out there. We don't know what the final legislation will look like. So this is still kind of speculation, but we wanted to at least get in front of you so that you're thinking about it and you're having those conversations now rather than after legislation takes place and it may be too late, because sometimes it's retroactive. Sometimes, with PPP loans, it was right at the end of the year. They didn't give much time for people to adapt and make changes. So the topics we're going to cover tonight, Federal tax rates. Some of these, you probably have some ideas where we're headed. Long-term capital gains rates, net investment income tax, Social Security tax, retirement plan contributions, itemized deductions, the qualified business income deduction, and then a little bit on estate tax. With these, there's two scenarios we're going to include as we go through each of those topics. I'll go over the details of the scenario so you kind of know the numbers we're working with. These are totally just numbers I came up with, and I try to keep them, round and even to make the math a little bit easier on us. So this first scenario, we have two doctors, Michael and Susan Smith. They file a joint tax return. Michael has W-2 income of $200,000. Susan has W-2 income of $300,000. And then Michael also receives a K-1. In this scenario, we're assuming the K-1 is an active investment with income of $425,100. Along with that, they have long-term capital gains of $100,000, and they're taking the standard deduction under current law of $25,100. With all that information combined, that gives them a estimated taxable income of $1 million even. In the second scenario, the only things we've changed is we've increased the W-2 income. So for Michael, we've increased it from $200,000 to $400,000, and for Susan, we've increased it from $300,000 to $600,000. So that gives us a bottom line estimated taxable income of $1.5 million. So just kind of keep those numbers in the back of your mind. We'll bring them up as we go through each topic so that you can kind of see what the potential tax impact is under today's information and what we're looking at with the President Biden proposals. So the first topic is the top federal tax rate. As many of you probably know, the tax rates there's various tax brackets. So if you're in the top bracket, which is currently 37%, you are not taxed every dollar at 37%. It goes through the various brackets. And then once you hit the top bracket, every dollar earned after that, or every taxable dollar, is taxed at that 37%. So in this summary I indicated on the 37% that for the 10% bracket, 19,900 is taxed there. Under 12%, 61,000, all the way down. The 37% bracket under the $1 million scenario one, there's $371,700 taxed at that top bracket. And that results for the 37%, the $1 million total tax would be $306,523. Now, looking at the exact same scenario under Biden's proposal, Biden's proposing that we move the tax bracket from 37% to 39.6%, which, just under 3%. It's not a huge impact, but you'll see as the numbers get bigger, there's definitely an increase. So he hasn't proposed all the ranges of the brackets. So we've assumed that from 10 to 35% that our bracket thresholds are the same, but on that 39.6, that increases the tax to $147,193. So our overall tax between the two scenarios results in a tax increase of almost $10,000. It's that $9,664. So if nothing else changes and this goes through, you could be paying an additional $10,000 in tax just by that change. Looking at the top federal tax rate for the second scenario, where we increase taxable income from just $1 million to $1.5 million, so another $500,000, under today's laws, we would be looking at total tax of roughly $491,523. But under the Biden proposal, you're looking at tax of $514,000. So that's an increase of almost $23,000 in federal tax, just by him potentially increasing the top federal tax bracket. In order to potentially avoid this, the easy thing pops head is make less money. Well, that's not what, people need to make money to live. they're not going to just quit their jobs. But there's some other planning ideas to maybe circumvent this and to plan ahead. One of them being a Roth conversion. So usually under Roths and Roth IRAs, the money goes in after tax, and then you don't pay tax when it comes out. So when people look at the Roth conversion, the first thing they think of is, do I want to pay the tax now, or do I pay the tax later? Usually they're looking at their tax brackets. Under today's law, most people think, okay, I'm probably going to be a lower bracket down the road. Well, now that Biden's come in and doing these proposals, for some people that may not be the case. They may be thinking, oh no, I might be in a higher bracket down the road, and I would rather pay the tax today, and then I don't pay it later. And if I don't use it and I pass it to the next generation, they also don't pay tax later. So that is one way to potentially pay at the lower tax rate on those items and not the higher rates going forward. Another idea would be just doing Roth contributions or the backdoor Roth. In order to do a Roth contribution, it is based on income limits. So most of the physicians I work with, their income level's too high to make a direct contribution to a Roth IRA. However, the backdoor Roth is like it sounds. We're doing a backdoor way to get into that Roth IRA. So they'll make a non-deductible contribution to their IRA. So since it's non-deductible, that is after-tax money, and then convert it to a Roth IRA. So if you put $5,000 in, do an immediate conversion, that potentially will have no tax impact. And I say potentially because they look at all your IRAs combined. So if you have other IRA accounts, that can taint that basis. And so then it's not truly 5,000 in, 5,000 converted, and don't pay tax on that $5,000. So that's definitely where you would want to discuss with your trusted advisors, is this a planning opportunity for me? And what is the potential tax impact if we go that route? Another one, which isn't on the slide, would be, as physicians are if they're getting closer to retirement, there may be some that decide to retire a little early or start pushing themselves there sooner than expected, just because of tax rates going up, so that they can kind of manage their income tax brackets a little better in retirement than they can in their higher income earning years. Any questions? Okay.
So far.
Okay. We will keep moving. So the next pain point I hear from clients currently, and it's probably a big one, is long-term capital gains. So currently, they have what we call a preferential tax rate, meaning that it is a lower tax rate even if you're in the top bracket. And I say long-term because the short-term gains are taxed at your ordinary income rate, and that's how it's been. Long-term gains are taxed at 20%. There are lower long-term rates if your income is under these thresholds. So if you're single and your income's under roughly $446,000, you could be taxed at a lower rate. And same thing if you're married filing jointly and your taxable income's under $502,000. But assuming we're all over those levels, it's a 20% rate. So using our scenario, so both scenario 1 and 2, we had $100,000 of long-term capital gain. That would result in $20,000 of tax on that income. Everything else the same. Under Biden's proposal, he wants to tax long-term capital gains at 39.6%, which would be that highest federal tax bracket we discussed. He's currently proposing it to be on individuals with income over $1 million. At this point, he has not clarified if that's taxable income, gross income, adjusted gross income, but we're kind of looking at that $1 million number. And based off the scenarios, then you guys can probably do the math in your head on that $100,000 long-term capital gain, that results in tax of $39,600. So that's an increase of almost $20,000 just on $100,000 of long-term capital gains. So that's like I said, a huge pain point for clients. I had clients calling me prior to Biden even taking office because this was already coming out what he was proposing. So I have some planning ideas. I just recommend that you don't panic, talk to your advisors, like we've mentioned, because some are like, they just want to sell out of the market. And I mean, I'm not a financial advisor, but definitely have those conversations before you do anything drastic. As far as, yes.
Just a quick point of clarity, could you maybe give a few examples of what type of assets you see pretty common that physicians would own that would be subject to capital gains? I think stocks are obviously the easy one, but anything else that you see pretty common that maybe a physician needs to keep in mind that could be subject to capital gains tax?
Yes, yep. So definitely, like Cameron said, the stocks, mutual funds, anything in your investment portfolio. The other one would be investments in partnerships or investments in S corps. If you sell your ownership, so if you're an owner in a surgery center or in a medical practice, when you sell those, a portion, if not all, is usually subject to long-term capital gains as long as you've been an owner for more than a year. The other thing is, even if you don't sell just your individual interest, but if you guys decide to sell the practice to somebody else, that can also trigger capital gain. And when I say sell interest, you don't have to be selling all of it. You could sell, part of your interest, and that can trigger those long-term capital gains. So that's probably the most common we would see with physicians is the investment portfolio, and then their investments in business entities as well. For the capital gains planning ideas, one would be recognize capital losses. So if you have an investment portfolio and you're rebalancing, or you just need to sell it to raise funds, whatever the need is, working with your advisor to see what assets you may hold that currently have a loss. You may want to sell those at the same time. Those losses will directly offset the gains before anything's taxed. Whether it's a short-term or a long-term loss, they will offset short-term and long-term gains as well before they're taxed. The other one would be related to the appreciated securities. So if you have securities, mutual funds, stocks that have grown substantially and have these large unrealized gains attached to them, you can donate those directly to a charity. So let's say there's a church or some other foundation that you like to donate to annually. You can give them those securities. You get the charitable donation that you were going to get anyways, and you never pay the tax on the gain related to it. So it kind of takes care of both things at once. The other way you can donate appreciated securities is through a donor advised fund. Those are usually set up with your investment advisor. So that's how you would set it up and actually fund it. But you establish this account, you put appreciated securities in it. The year you put those securities into this fund, that's the year you get the charitable deduction. So you could put, let's say, 10 grand in this year just to fund current year donations, or you could say, I'm retiring in 2 years. I want to put 200,000 in to cover this year's donations plus donations in retirement. The reason I mentioned doing it in high income earning years before retirement is there are still caps on how much charitable deductions you can donate you can deduct based on income. So you want to take advantage of these bigger deductions to offset that higher income in those higher tax brackets. And then in your retirement, you kind of have some of your charitable contribution funded. You won't need to take extra money out of retirement plans because distributions from those can be taxable. So then you kind of already have that cash flow set aside. In the donor advised fund, upon death, it's just like a retirement account. You set up beneficiaries. So the money's in there and you can leave it to the next generation to continue with some of your charitable giving wishes, and they can then pass it on and pass along donations during their lifetime as well. Okay. Next topic, net investment income tax. The net investment income tax came into effect with Trump in office when he did his tax reform. And a lot of you are probably familiar with this. So that is a 3.8% tax on investment income, which investment income is interest, dividends, capital gains, and passive investments. The tax impacts those that have the modified adjusted gross income greater than 200 grand if you're single, or 250,000 married filing jointly. So a lot of people are getting hit with this. In our scenario, the only investment income we included was the long-term capital gains of 100,000. The K1 income, as I noted earlier, we were assuming that's active. If you have an investment where you receive a K1, it's usually either deemed active or passive. So active investments won't be a part of this. But if you have passive investments, then that income would be included. In our scenarios 1 and 2, the long-term capital gain of 100 grand results in an additional tax of $3,800. So that's pretty cut and dry. President Biden's proposal is that we keep the 3.8% tax. However, we put that on all income, not just investment income. So now you're including the W-2s, the active investments, and all of those are now included in here as well. He has not come out with any sort of income limitations. So you see currently we have your adjusted gross income has to be over a certain level before you're hit with it. As of right now, he hasn't specified. So we're assuming it's going to be on all, but that could change. So in our first scenario, all of our income before deductions was $1,025,100. So that results in this additional net investment income tax of roughly $39,000. That's an increase of $35,000 under the current tax laws. Under our second scenario, we have income of just over 1.5 million, and at 3.8%, that puts us at an additional tax of $58,000. So you're looking at an increase of $54,000. Just on the net investment income tax, which would results in federal tax rates plus this, also results in capital gains plus this. So, you're looking at 39.6 plus 3.8 potentially on top of that. So that puts you at, about 43.5% tax.
Perfect. That was the question I had asked of me, so thanks for hitting that.
Yeah. Okay. Any questions so far? Are we still good, Cameron?
Nope, it was just that one, and you asked, and that was the answer was it's capital gains in addition to that net investment tax. It would be both.
Yep. Yeah, so they just keep getting us. So the next topic is Social Security tax. The current scenario, any of you that are a W-2 employee are probably familiar seeing this on your W-2. It's 6.2% for both the employer and the employee. And each year there is a wage base. So up to W-2 income to this wage base, you have Social Security tax. For 2021, that wage base has increased to the $142,800. So your capped Social Security tax you're going to pay in is $8,852. You'll probably see those numbers on your W-2. Under the Biden proposal, he's keeping that 6.2%, and we're still going to have a wage base of the $142,800, at least for this year. His proposal, though, is to then say from that just over the wage base up to just under $400,000, that's not subject to the Social Security tax. But once you hit $400,000 and above of W-2 income, now we're going to tax it again. So it's kind of going to start piling on. So in our first scenario, we had they had W-2 income of $200,000 and $300,000. So they're both under that $400,000. So they're just going to get hit with that $8,852. So the taxpayer and spouse, both $8,852. So in scenario 1, they have that Social Security tax of $17,704. Now in scenario 2, they're going to have that. Michael's W-2 income went up to 400,000 even. So I'm not going to bore you with doing math on a dollar. But Susan's went up to 600,000. So 400 to 600. So we have $200,000 more that'll be taxed at 6.2%. So we have another $12,400 of Social Security tax. So that brings us up to $30,104 on their wages that's being held out.
I had a question on that had a question on that. So they're wondering, how does this play into, let's say, if you're a private practice physician and or maybe you have K-1 income. So in this situation, is there potential ways to get around this additional tax, or is there a benefit of being a private practice or having self-employed income?
They haven't really delved into how this is going to impact self-employment income. If it carries out like it is currently, then you would still have a 6.2% at the varying levels. So if you're a partnership in that self-employment income, there may not be much of a way to go around it. Now, if you're an S Corp and you pay yourself wages, they still have where you have to pay yourself a reasonable compensation, which is kind of a gray area. So I'm sure some people will be playing with that as an S Corp to keep themselves under 4 or right close to it and not, have that $1 million wage to ensure that they're not paying the additional tax involved here.
That's all we had on this one. Thank you.
Okay. Okay, so the next topic we have is retirement plans. And this mainly focuses on the 401k, 403b, the ones that you're, doing through employers, the pre-tax contributions. Under the current plans, the value of your deduction rises as your income increases. Since it's pre-tax, you're avoiding that potential, tax on income. So keeping it simple, if you contribute $100 and you're in the lowest bracket, 10% bracket, you're looking at $10 tax benefit. The highest bracket, you're looking at a $37 tax benefit. So the higher income earners are basically getting a higher percentage benefit by contributing. Biden wants to make things equal. So his plan is that they will equalize the benefit regardless of income level, which results in an increased benefit for these lower income earners. But now all the higher income earners, their benefit is decreasing. So their benefit's going to be less than 37%. And lower income earners is going to be higher than 10%. Under Biden's proposal, it is going to be a refundable tax credit, because if we do them pre-tax, you can't equalize it like that. Or he'll do it pre-tax and then true it up on the tax return. We're not sure how to play out. But he wants to do a refundable tax credit, and he wants the credit to be 26%. So that'll show you kind of, some people in the middle brackets, 22, 24%, it's not going to be a big swing. We get 10%, now gets a 26% credit, which it does encourage them to save more for retirement, which is helpful. But the higher income earners, they're not getting as big of a benefit. So I'm not sure if that'll impact some of their saving or not. A lot of that'll be a discussion with tax planning, financial advisors, and to see long-term retirement planning and cash flow to see what they need and where's the best place economically to put their money.
Yep, that was one of the questions we had, is does this maybe change the bias or lean people towards pre-tax or Roth if they have the option inside of their retirement plan? And you kind of just answered that.
I think it will. If you have the Roth 401k, I think if people aren't already utilizing it, they may utilize it more and shift everything. I know some people try to do a mixture, say like multiple buckets in retirement of taxable versus non-taxable when they withdraw. But yeah, I could definitely see a swing to more Roth retirement plans. And the one thing with Roth retirement plans, when you retire, if you roll things to the IRAs, 401k to a traditional IRA and Roth 401k to a Roth IRA, On those IRAs at 70 and a half, you have to take money out, and they tell you how much to take out. In a Roth IRA, you don't ever have to take it out. So you take out what you want, but there's no requirement to withdraw. So it'll be interesting how this plays out, because there's long-term effects to these current potential changes. Okay, itemized deductions. This was a big one when Trump made changes, so it'll be interesting to see how this one plays out. So as many of you likely recall, I'll go back pre-Trump, we had state and local tax deductions, or the SALT deductions, which includes your real estate taxes. In Indiana, we pay auto excise tax on our vehicle registration. That's a state and local tax deduction. And then the other big one is state and county withholding through a W-2 or quarterly tax estimates paid to a state. In Trump's change, one of the big ones that impacted physicians, a lot of them in a negative way, was he put a cap on that deduction. He said, you get 10 grand and that's it. So for a lot of people, that they were hitting that. I mean, they're exceeding that. So that really did limitate them. The other thing he did was he eliminated what we call a Pease limitation. The Pease limitation is named after a gentleman with last name Pease. And basically, it would reduce your itemized deductions by 3% for income over certain thresholds. And so in 2017, those thresholds were lower. They were 261,000 single, 314,000 joint. Under Biden's proposal, he's wanting to reinstate the Pease limitation for anyone with income over 400,000, and he wants to reduce it 3% dollar for dollar. The other thing is he is removing that 10 grand SALT limitation. So anyone that's not receiving full benefit could potentially be getting a lot more of those deductions back. So this is one, definitely I recommend tax planning. You're gonna have to run the numbers to see how it impacts you. But I do have some planning ideas just to open some discussions with your advisors. The first one would be in relation to the SALT deductions, quarterly state estimated tax payments. They're paid quarterly 4 times a year. The last one is due January 15th of the following year. So you can pick and choose. Do you pay it by December 31 to get a current year deduction, or do you push it and pay it in January to get the deduction next year? So that's always something before Trump's change that we would work with clients on. You know, when do we need this deduction? When do we get the biggest benefit of this deduction? So that's where running the numbers is helpful to see with the Pease limitation and those things, where is the better benefit for the client? The other idea is to potentially bunch up charitable contributions in alternate years and then alternate that with the standard deduction. And this is under the assumption that Biden is not going to lower the standard deductions. That was something Trump increased. We're thinking Biden might keep them up where they're at currently. So basically, like a donor advised fund would be a great way to bunch charitable contributions. You have it funded, you get the deduction. You don't have to give them to the charities right now. So do that in 1 year, get your large deduction, and then the next year just take the standard. So that, but that'll allow you to plan from year to year. So that is an idea. It's also an idea if you kind of are on borderline of itemizing versus standard, that can kind of push you over. Let's, do this 1 year, get us over it, make sure we itemize, and then the next year just be slightly under and take the standard deduction.
Is there some additional benefit? So I know that we've had some clients to come to us with questions. Maybe they have been charitably inclined. Is there some additional tax benefit currently, just in light of some of the CARES Act that related to COVID? Is there additional tax incentive for them to be taking charitable contributions today in the way that they take those deductions? I know that there are some changes with that.
Yeah, so in 2021, they haven't pushed it through. In 2020, they did allow some charitable deductions if you took the standard deduction. So they did, even though you took standard deduction, you could take it there up to, I think it was like $300 of deductions on your federal return. And then but it was a state add back. So the states, not all states followed. Indiana did not follow. So you got a federal deduction, and then Indiana did add it back. For this year, they haven't come out with anything related to allowing some additional deductions. So we're kind of at the same thresholds and income limitations as we have been related to the charitable donations. Any other questions on the itemized or charitable?
Nothing yet. If anything pops up, I'll let you know.
Okay. Okay, the next topic was also new with President Trump, the qualified business income deduction. So this will relate anyone that has a business or is invested in a business. So if you have a Schedule C or you receive K-1s because you are part of a medical practice group, this was something that was probably talked about with you. Now, you may or may not actually be receiving the deduction though. The deduction is a 20% deduction. If your business is deemed to be a qualified trader business, there is no income limitation. You qualify for up to this 20% deduction. I won't bore you with the details. They also look at wages and your fixed assets within the business, but we'll go up to 20%. If you are a specified service trader business, which most medical practices are, surgery centers and some other like specialty hospitals do fall under the qualified trader business. But as a specified service trader business, there are some income limitations. Currently, under the current laws, this is set to expire at the end of 2025. So we have the QBI deduction. If nothing changes after 2025, this just goes away and we go back to normal. Using our scenarios, we have the $425,100 of K-1 income, and assuming we get the max 20% deduction, that would be it's a federal tax deduction of $85,000. So it's a nice little deduction. What President Biden is proposing, he wants to keep the 20% deduction. However, your income needs to be under $400,000. So if you make more than $400,000, you're phased out. So that's kind of where there's a lot of people that are benefiting from this now, and he's wiping a lot of people out with this. So people just aren't happy about it. I mean, a lot of the businesses that are receiving this benefit don't like it. Specified service trade, and I'm sure a lot of, as physicians, especially if you husband and wife are physicians and you have these investments, it can be hard to be under that $400,000 number of total income between and your portfolio income and everything included. So he's really going to wipe out quite a few people on this deduction. Any questions on that one? Okay. Okay, we're moving right through. Okay, next up is estate tax. So hopefully nobody has to worry about this for a while, but just so you're in the loop, and as far as doing your own estate planning and long-term financial planning, under the current laws, all the assets you hold at death, there's no capital gains tax on them, nothing on the appreciated securities. Your heirs will receive what we call a step up in basis. So if you have, let's say you have, you're invested in Apple stock and you bought it many years ago before Apple was as popular as it is today, and you paid $5 per share. So you're holding on to it because you don't want to pay capital gains tax on it. And when you die, whoever gets it, they get this step up in basis. So whatever the value of Apple is on the day you die, that is the new basis. So if it's $200 per share, let's say you leave it to me, I now have it at $200 per share. I can turn around and sell it, and I'm basically going to pay little to no tax on, the wealth you just transferred to me. Currently, and that applies, I'll back it up. That applies not just to stock and mutual funds, but that would apply to other assets as well. So you may have investments, you may have investment property. That step up in basis applies to multiple areas. Our estate tax, currently the top tax rate is 40%, but you have an exemption per person of 11.7 million. So you got to get over that exemption and then you'll start paying tax. There is lifetime exemption. So if you are someone that gifts to family a lot, your exemption may already be reduced some, but in this scenario, we're assuming that you have the full exemption amount. Biden, however, his proposal is that on the day you die, any unrealized gains, so that means all these assets are appreciated and you haven't sold them to recognize the gain. If anything that's over $1 million on your date of death, the tax should be paid right then and there at the estate level. Still 40% top estate tax rate, so that's not changing. Still the $11.7 million exemption, so that's all fine. But the other big hit is he wants to repeal the step up in basis. So in our scenario of that Apple stock, $5 per share, now you pass it on to, now you're paying, if we assume you have over $1 million in unrealized gains, you're going to pay tax on some of it. Then you're going to pass it on to your heirs, and they're still only $5 per share. And if it's worth 200, they're paying tax on $195 of every share you own. So that's a hit to your heirs as well. So that's where estate planning is crucial. Your current estate plan, and you're like, oh, but I have a lot of clients that do it. They had these investments, they've been passed on, or they have a spouse that was, an Eli Lilly executive or Duke Realty, and has received these stock options and shares with really little to no basis. They're going to hold on to them, let their next generation get the step up in basis, and that's the wealth they're transferring. Well, under Biden's proposal, you've now potentially passed a huge tax burden onto the next generation. Some people may say, that's fine with me. I worked hard for it. That's, if they want it, they can do that. And others don't want to pass that on. So the biggest planning takeaway on the estate tax is you need to,
You said a quick question before you moved on. For the unrealized capital gains, someone asked, is that taxed at that estate tax rate then, or would it still be the capital gains rate on whatever hasn't been realized?
Good question. And I don't believe they have specified that.
Okay.
I'll see if I can find it real quick. Okay, so it is going to be at the 39.6 plus, so let's see. That their individual rate would be 39.6 plus the 3.8. They are not specifying what they're going to tax that at, because it doesn't, the 40% relates to the amount above the exemption. Mm-hmm. And since they're taxing that before you take the exemption into place, they have not, I just looked up, they have not specified what tax rate that's going to be. If it's going to be the 39.6, mm-hmm. if it's going to be 20%, or if they're just going to pick some other arbitrary number. But 39.6, 40, they're all about the same. So I would assume it's probably
around there.
Not going to be low.
Yeah.
Yeah.
But just as a word, like the exemption being at 11.7 now potentially from Biden, that is a big improvement. There was some big talks about that being drastically cut, which would have really impacted. And again, this is still proposals, but that has changed even recently. So that's some hope.
Right. And taxing unrealized gains that exceed $1 million. So, people watch, if they're watching their portfolios, then they can they can have up to $1 million of unrealized gain and be okay. It's just once you get past that amount. Good questions though. Okay, so the biggest planning would be review your estate plan. Obviously, you can bring your attorney in because if you need to make changes, they may need to be involved, but definitely your financial advisors, your accountant. You know, in my office, we have people that strictly work on estate and trust tax returns. They know the state laws inside and out. You know, that's another great resource. They're going to be able to help you understand the laws and know what potential loopholes are there or how to configure your assets to ensure that you minimize the impact of these laws. And that's something you should review your estate plan regularly, but just with these proposals out there, it's at least worth the conversation to get a plan now. Because like I mentioned earlier, when they pass these laws, they don't worry about, oh, do we give everybody enough time to make changes? They they just pass it, whether they do it now and make it retroactive, which kind of puts people in a bad situation, or they do it, you know, December 29th and it takes effect 1/1 of the next year. So definitely kind of having the conversations now, and if you feel like you need changes, kind of get at least the drafts in place so that you could execute them. I would start those conversations sooner than later. Okay, so we have just a brief summary of kind of the financial impacts we discussed under the two scenarios. So you guys can kind of see the overall impact. So under the scenario number 1, that resulted in taxable income of $1 million. With the changes, we looked at an increase in just the federal tax of, I'll just round off the numbers, of $10,000. Long-term capital gain tax increase of $20,000. Net investment income tax increase of $35,000. So what, we're up to about $65,000 in increase in tax. And under this scenario, the Social Security tax, there was no change. So, I mean, that's pretty significant. If all else is the same in your tax situation and you're that $1 million taxable income, paying an additional 65 grand in tax, you know, that's definitely a hit to the cash flow. Under scenario number 2, so that was the 1.5 million in taxable income. We're looking at a federal tax increase of just under 23,000. That long-term capital gain increase of 20 again. The net investment income tax increase of 54,000. And Social Security tax increase of just over 12,000. So that puts us, if you, including the Social Security tax increase, that's over 100 grand of additional tax just by Biden's tax increase proposals coming into effect, whether that be in 2021 or 2022, depending what they do. So definitely tax planning is in order for everyone. I will tell you, I mean, you can call your accountant and discuss these. It is hard to do tax planning because it is a lot of what if scenarios. You know, we try our best and we can do what I did where we say, okay, based under current law, this is what you're looking at. If he comes through, this is what you're looking at, and kind of plan. We don't always want to take extreme measures because, you know, we don't want you to pay in $100,000 of extra quarterly estimates to cover it and then nothing happened. And now the IRS has a free loan for, you know, however many months are left in the year. So we, in our office, we're planning on a lot of year-end tax planning, being very busy, and even clients that maybe don't normally need it, there's enough changes that we're going to have to kind of at least give advance notice. So even if they do have to pay, they at least have a heads up of what to expect when filing their 2021 tax return.
We did have one question. What is the precedent when these tax changes do happen, whether it's capital gains, whatever the case would be? Is it traditionally in the current tax year, or more times than not has it been the following tax year and beyond?
Usually now we're getting halfway through the year, it's usually future tax years. Won't say it can't be done.
Of course.
Not that we want COVID and the pandemic to persist, but the longer it does, that is the focal point. So these things are getting pushed aside, as they do the PPP loans and the stimulus packages. We didn't talk about it here, but, some of you may be aware in July, anyone that has children and they get the child tax credits, they're increasing those and they're front end loading those to taxpayers. So for July through December, you're getting a portion of it sent to you by direct deposit or check once a month and taking some of it now. So the IRS, Biden, I can pass it, but I can tell you the IRS is not prepared for this to happen. And some of you probably sitting here watching and listening to me talk had a tax refund and haven't received it yet. The tax extended deadline to May was for no other reason other than the IRS was so far behind, they needed a little breathing room. So I'm thinking it'll go to 2022. It'll be all effective next year, but can't hold me to it because we don't know, but that's kind of what we're planning for, is that we're going to be moving it. Retroactive, that'd be a bad situation. But anyone that's familiar with the government, these are Biden's proposals. There's a good chance this is what he's proposing, but it's very rare that this is how it actually ends up. There's, enough discussion and compromise that it's probably going to be somewhere in the middle, or he will pass some of these, but not all. Yeah. This is my contact info. So if you want to reach out to me directly, it also includes our website and 800 number if you want to call. And if you have questions specific to tax or specific to healthcare or other areas, if I'm not the right person, I can definitely put you in touch with someone in my office that can help you. Any other? Did we get all the questions?
I think so far. We'll be on for just another minute or two. So if you guys have any other questions, feel free to just chat them out there. So just wanted to say thank you so much, Abby, for the really, really good content. Obviously, there's a lot of what ifs, but I think it's pretty evident that this is a big tax planning discussion that really should be happening. And if it's not happening, it's something that we would encourage you to start thinking of. The one thing I will say is obviously Somerset in general, we have a lot of confidence, and we really like that they do work specifically with physicians. So it is helpful. You could just tell the knowledge that Abby has specific to physician, the surgery centers or whatever the case would be. It does help in that planning of really having the niche specialist on your side. So again, if you would like to connect with us at Vestia, you're welcome to email us directly at myteam@vestia.com. We really just touched on some of the subjects. Obviously, we could go down rabbit holes for multiple hours, but your time is very, very important. So we just wanted to hit the wave tops here. But we would be happy to talk you through any of these items, and then obviously collaborate with your existing CPA. If you don't have one, happy to get you in touch with Abby and her team. So thank you so much for your time. Abby, thank you so much again for your expertise.
Thank you, Cameron.
And I hope everyone has a great night.
Thank you.